What's up, everybody, and welcome back into the RonnieV show. Today, I'm going to be talking about two stocks that I just completely sold out of my public portfolio, and we're going to be going over the 7 other stocks that I have in this public portfolio, what the breakdown is, and why I'm so bullish on all 7 of these stocks using my personally built high five snapshot, which is my Excel spreadsheet that basically helps me determine whether or not I should be buying, trimming, or completely selling out of a position. Without further ado, let's get into it. You see here on the screen, we have my $10,000 high five portfolio account completely broken down into all of the categories here. As you can see, we hold Meta, Amazon, Google, Delo, Hims, UNH, United Health Group, Oscar, and the 2 stocks I completely sold out of, Tempest and PayPal. So there it is, guys. I gave you the whole thing right up front. If you want to leave the video, congratulations, you got all the names. But if you want to stick around a little bit longer, I'm going to be going into why I got rid of Tempest and PayPal in this portfolio and why I have these other 7 positions based on my high five snapshot and a little bit more of my portfolio breakdown. Guys, it takes me a lot of time to make these videos, and I really appreciate it if you smash that thumbs up button, smash the like button, hit the subscribe if you want more deep dives like this into stocks, if you want more portfolio reviews. This is my public $10,000 portfolio that I started back in April of this year that I really built to show everybody out there on X and on YouTube and other social media platforms that I'm on how to properly build a portfolio that can win and consistently beat the markets consistently. So if you're interested in that type of content, trading content, investing content, I would definitely drop a subscribe here, guys. And only other thing I have to talk about before we get into this video is we are running a 4th of July sale. It ends tomorrow. It ends Monday. And this is basically 50% off the investing tier, trading tier, and the high five trading pro tier. So if you're looking for 50% off to jump into our community over here on the WAP app, you can get on. You can come over here, use code America. I'll leave it linked in the description below as well. And if you're not following me on X yet, you can come follow me at the RonnieV Show. We're about to hit 15,000 followers, 15,000 amazing friends that we constantly are on here talking about stocks to invest in, trade. What are the next 10 baggers? What are the next 100 bagger stocks? And what companies are we looking at to basically make some profits on as well? So now that that's all out of the way, let's get into these actual stocks: Meta, Amazon, Google, Delo, Hims, UNH, and Oscar. Now, I'm not going to lie. Before Oscar took this big dump this past week, I was positioned probably about 50 some percent in tech and about 20%, 30% in finance, and only like 20 to 30% or so in health stocks. But I've completely flipped the script on this. And I am actually mainly invested 54%, as you can see on the screen, in these health stocks: Hims, United Health Group, and Oscar. Now, I'll get into those in a little bit, right? And I'll get into my bull thesis. But essentially, all you need to know is that I have a full position built out in Meta, Amazon, and Google, and Delo, because one, Meta, Amazon, and Google ran away from me. They're only at an 18%, 19%, and 22% margin of safety, basically meaning that how far off they are from their fair valuation based on my assumptions on the high five snapshot, right? So on the high five snapshot here, Meta with conservative assumptions, we can see that the free cash flow yield and forward free cash flow yield looking pretty strong. The PE is okay, and you're going to pay a premium for Meta, 28 forward, 30 current PE, and I'm okay with that. But I was buying Meta in the 5 and 600s at a 30 to 40% margin of safety, and I built out a pretty strong position there. I built out 60% of my position, and at this time, being only 18% margin of safety, I've decided to cap off Meta and kind of build up other positions, right? So as you can see, Strengths: dominant social ecosystem. Weaknesses: privacy controversies, obviously. AI driven ad targeting. They are becoming super in. They're becoming really big into using AI to generate their ads. Meta is mainly an ad business. They do have Oculus. They're spinning up WhatsApp. They have Threads. They have a lot of other businesses, but mainly it's social media and it's running ads. So businesses constantly pay them money to run these ads. And the one thing that I like most about this business is the fact that it's so consistent. Meta has over 4 billion users of all their platforms. So, they basically have over half the world's population using their apps on a consistent basis, on a daily basis. So very consistent revenue business, very consistently profitable. Free cash flow looks amazing. Like I said, 18% margin of safety. It's still a buy today. You'd be looking at 10 or 11% annual CAGR based on free cash flow or based on EPS. But me personally, I'm just looking at it and I'm just sitting here saying, I was buying it. I built 60% of the position. I'm just going to cap this out and move those funds into other positions. So that's really Meta. You know, uh, Another big bullish thesis that I have on Meta, and why I think it's a long-term hold, besides all the social media stuff, is the Ray-Ban AI smart glasses that they're really coming out with. I think that could be the future. I think that could be a really big driving revenue factor for them. And finally, if you guys don't know, Zuckerberg has just been poaching OpenAI workers. He's been poaching all these workers from these big AI companies. And he's really betting big on AI and just trying to build a super team, as he says. He's trying to build this super team over here at Meta and just trying to build a super team and just take over the AI market, honestly. And I think they have a good opportunity to do that with the great minds that they're bringing over from OpenAI, Anthropic, Grok, so many others, right? So I think Zuckerberg being founder led, I think he just continues to crush it on Meta. I was buying this name down in the 80s, not in this specific portfolio, one of my other portfolios, but this name and this stock is just it's a money maker over the long term. It's a name that I wouldn't be surprised 5-10 trillion dollars in the next 5 to 10 years is what we're looking to hit. So for this year, I think they can hit $1,000 per share potentially. If we do go on this super cycle bull run, I would probably say more conservatives, probably like $800 to $900 per share by the end of the year. So that's the first one, Meta. The second one is going to be Amazon. Amazon, it's a 12% weighting. All these tech positions are a 12% weighting of this $10,000 portfolio. And if you're wondering about the gain so far this year, we have an $11,000 portfolio size because I add $500 per month. Account total is $12,468 as of last Friday. Our total gain is 8% so far. $651. Total cash position is about 15%. And I am going to look to build that back up to 30% now that we're back at all-time highs. Amazon. They are the king of e-commerce, right? They're the king of e-commerce, and they're the king of with Amazon Web Services. So much of the internet, so much of these businesses out there, including Palantir, run through Amazon Web Services, and they've just really built out such a great cloud service that they are number one in the cloud service and leaving, Google and Microsoft with Azure. They're leaving them in the dust a little bit, right? And they are front running. They are number one. I don't think Google or Microsoft will be able to dethrone them in this because they do so well at keeping that distance. But at the same time, you have to realize that Amazon also has a ton of other great businesses that they are in. They basically have, I think, over 50 total businesses across their entire, umbrella. But the main ones are really their e-commerce and their Amazon Web Services. And number three is the ad business now with Amazon Prime. With Amazon Prime, the subscription service, right? It goes with the e-commerce, but they are also obviously having and competing with Netflix and Disney Plus and Apple TV. They're competing with them, and they're essentially driving ads on that as well now. So they're really getting big in the ad business and just showing ads on Amazon when you're shopping, and yeah, they're becoming really big into the ad service sector as well. And I think that's just another great revenue growth driver for them. And yeah, if we look at the high five snapshot here, I have a $277 fair value for Amazon, a 19% current margin of safety. Another reason I capped this one out, I really only like to buy at 20% margin of safety or more. So I like, 30%, 40%, 50% is whenever I build my full position out at 50% margin of safety. So 19% margin of safety is good. Amazon's still a deal right here today, but I just don't think it's as big of a deal as when I was buying it. And I think there's other companies out there in this portfolio that are better deals, which is why I'm putting my stake and putting more money into those at this time. So yeah, free cash flow yield, PE, it's a bit rich, but it's Amazon, guys. It's Amazon. You are getting the leader in e-commerce. You are getting e-commerce growth for as far as the eye can see, and you are getting Amazon Web Services with similar, yeah, growth as far as the eye can see. Basically, they're only going to get bigger, and they start to build into other dynamics as well. So the SWOT analysis, e-commerce and Amazon Web Services scale, weaknesses, thin retail margins. Yeah, that's always been a thing. They've consistently not made money on the e-commerce business, the retail side of things. They've mainly been able to make up for everything with Amazon Web Services. So I am looking at them to basically, improve on the retail side of things and make money from all those billions and billions of dollars in revenue that they make from the e-commerce side. And then AI logistics optimization. Um, they are really getting into robotics, and this is where I think their margins are going to expand because they're bringing in all these robotics into their warehouses, and with those robotics coming into the warehouses, replacing workers. Sadly, right, workers are going to get replaced by AI and robotics. But by being able to do that, they're going to drive that bottom line, and they are going to become very profitable and really expand those margins with those robots, and basically paying less. Don't have to pay for healthcare, don't have to pay for employees salary, don't have to pay for dental, don't have to pay if they're out sick, it's all that good jazz. Overtime, they don't have to pay for that because they got robots just constantly running things inside the warehouse. So yeah, I think that's going to be a big driver for them to become very profitable on the retail side of things with e-commerce. And then labor and antitrust pressure. The labor thing, that's going to kind of get squashed out a little bit with robotics coming in for sure. And the antitrust, every big tech company is going to have to face that the antitrust stuff. So yeah, another big winner here in Amazon. Really like them, and just think they have a large runway of growth as well. Next up, we have Google. Google is another one, 22% margin of safety. I'm not buying any more here. I was buying in the 150s. I'm happy with where I was buying at there. And yeah, Google's fair value is 231, currently 179 today. They are starting to climb a little bit higher here. Google, obviously, it as if you're watching this on YouTube, they have the two biggest search domains and search engines in the whole world, Google and YouTube. I personally love watching YouTube. I love the content on YouTube, and obviously Google. I still use Google for everything. Honestly, I use Google and AI. I don't buy into the AI is going to, like, ChatGPT and everything is going to completely replace Google or eat a big portion of Google's lunch. I still think there's a lot of things that people Google and would rather do that and get those links and research than use ChatGPT or Copilot or anything like that. So I do think there's a world where Google can maintain and continue to grow with Gemini and Google search, while also ChatGPT and Copilot and Grok and Meta AI, Llama, whatever, I think they can be successful as well. So I think that's a contrarian view, but I do believe they can all live in this ecosystem. And I think, ChatGPT and everything expands on maybe work stuff and helping with work. And while Google search is just, vacations or like random things you want to Google, or get an answer for something very quickly, stuff like that. I still think, I still use it, and I know a lot of my friends still use it as well. So yeah, I'm not really buying that they're just going to die. And even if they did get their lunch eaten a little bit, they have Waymo, they have the robo taxis that are coming online and that are doing very, very well. They're number one in the robo taxi sector right now. And yeah, it's undeniable what they're doing with Waymo, and they continue to grow that. And that could be a massive, massive revenue growth engine for them in the years to come. So I'm very bullish on Google. Not selling Google anytime soon. I think they're very undervalued here still. Even though this kind of cash flow model has a 231, only 22% margin of safety. That's of a 25. We bumped it up to 30 forward terminal cash flow, free cash flow model, it'd be about 32%. So I'm keeping a little bit more conservative, but free cash flow yield, PE, current margin of safety on the discounted cash flow model, and I'm based on EPS. It's a buy all day at these prices still, 12% and a 14% CAGR going forward. So yeah, looks really good. Next up, we got D Local. They are basically taking over the emerging markets. They are accessing and allowing for um, basically cross-border payments in emerging markets, and they're basically taking the route of Stripe here in United States and everything, but for the emerging markets sector. So, or emerging markets in general, they're really going after those cross-border payments. Um, their their strengths are 15 to 20% free cash flow margin rates, as you see here. And that's me putting in for the next 1 to 5 years, being 15%, which they're already doing 15 to 20% now. So I go very conservative every time I do my high five snapshots, guys. I'm not sitting here just pumping up the numbers like crazy, crazy, crazy numbers, and then sitting here saying, yeah, it's $100 stock when it's only $11. Like, no, I'm conservative with this, right? Another huge thing here is emerging markets dominance. Like I was saying, they're really going after, becoming the moat, or becoming a moat, and taking over that entire emerging market sector, and operates in over 40 countries, guys. 40 countries with 900 local payment methods, scalable asset light model, strong profitability metrics, and strategic acquisitions. They just acquired Kenya-based AZA Finance, so that was a big, big win for them, acquiring them and getting in down into those markets as well. Like I said, they're expanding that reach to more and more countries, more and more markets. And I believe as they continue to do that, even right now they're undervalued. As they continue to do that, they're going to continue to grow and become more undervalued as they go, because this stock price and this stock is just being disrespected, in my opinion. The weaknesses we have here, biggest thing, exposure to volatile FX markets and emerging market settlement lags had led to significant receivable swings, pressuring free cash flow and introducing ongoing operational risk. So the biggest thing here, guys, is basically as money swings around, with different, U.S. dollar rising and falling, and other countries, other countries' money basically rising and falling, how much it's worth. You have this, you have a dollar being transferred into a euro, and euro being transferred into a dollar, and basically that transfer from one country to another, and especially in the emerging markets, that's all it really is other countries just transferring money around. There's fees that go along with that, there's differences, and a lot of the times that messes with the free cash flow, that messes with the revenues and net incomes of a D local, right? And with that, it creates a little bit of number fluctuation, like we were saying here in the weaknesses. So, but the one thing I will say about that is, recently, like a quarter or two ago, they basically had a big offset, and their free cash flow came down a lot from what it was consistently doing. It came down a lot because of those reasons. And I believe that it has basically given us a very, very great buying opportunity here. And that's why I've been buying D local in a lot of my portfolios, not just the public portfolio. It's the reason I've been buying D local in a lot of my portfolios because of that. Um, you know, when there's bad news, when there's something bad happening or something is fresh, like a fresh wound, then people are going to sell out and say, "No, I'm not touching that thing again," and kind of like, "Oh yeah, I'll stay away from it." And, we see this with a lot of these companies in here presenting these opportunities. When bad news stacks up, when bad news happens, when the numbers look bad for one quarter or something like that, people sell, and then you get this drastic overselling, and then you get a opportunity to buy that dip. And usually, especially if you do your research and understand when it's just fear, uncertainty, and doubt, and it's not really going to affect the business longer term. It's just some shakiness that happens with the business like this, which what we're talking about. Then you get a great buying opportunity for the long term. And yeah, I really like this one because of those reasons, because they had that free cash flow knocked down a bit, and I think they're going to just build that right back up. Revenue concentration obviously is a weakness. They're not spread out on tons of different revenue opportunities. It's really just the the consistent in the emerging markets. Really, there's no other revenue coming in or that they're really focusing on. Right. Guidance volatility. Like I said, when you're dealing with all these different countries, all their different currencies and everything, you're gonna it's one hard to um project accurate guidance is definitely a lot harder and less consistent. And then two, you're going to get those FX swings. So opportunities, geographic expansion. Like I said, 40 countries. There's so many more countries than that in the world that they can expand into. Undervalued stock. We already talked about that. $21 fair value I have on this thing based on a discounted cash flow model. 46% margin of safety. And that's basically, again, being conservative, doing 15%, 20% free cash flow margin rates for the next 5 to 10 years when they're currently already doing 15 to 20. Free cash flow yields 3 to 6. PE forward is 19-ish, and PE current is 22 with a 1.12 peg ratio. CAGR of 16% based on discounted cash flow model with a 10-year profit target of 50, and then a $31.87 price target with a 11% CAGR. So, with that being said, rising TPV and EBITDA, free cash flow yield expected to rebound. So, this was the big thing. Their free cash flow yield went down to negative 0.07%, and they're obviously expecting that to rebound back up to 11.2% to what they were doing before they had that big hit in free cash flow with the FX. Um, yeah, like I was saying, they already had that a quarter or two ago. They already had that big like, oh my gosh, and then this thing sold off like crazy because of that. And management has given their statements on it. They've told everybody, they told shareholders like we're gonna get this thing figured out, we're gonna get it situated, and they have, and they're expected to bounce back. And when they do report next, and as long as they do bounce back and report right that 11.2 or so, and people are going to be like, "Oh, maybe that was just a one-off, and we're probably good." And then you're going to see this stock climb like way, way higher, because there's an opportunity right now. This is very undervalued, and it's creating a very big opportunity right now to be a buyer here. Regulatory complexity, macroeconomic instability, and competitive pressures obviously are some of the threats for this company. But like I said, overall EPS on an EPS basis, on a discounted cash flow basis, free cash flow yield, PE yield, you're getting a very, very low risk with a very, very high reward on this company. As basically it's a double. It's almost 50% under where it's actually should be valued. So we're at 11.45 as of Friday, and I have a current intrinsic value, fair value of $21 on this stock. And Yeah, I think if they come in and do very well on their earnings, I think we could see this stock move heavily to the upside and get back to the glory days basically, right? Because they are a great company, they are continuously growing. You see that they have 27, 20, 18, so they're basically pegged to grow in the 20s to high teens over the next 10 years, weeding down to like mid-teen growth. So, yeah, awesome stock here. I really like D'Lo. I'm going to continue to be a buyer of this stock into July. And yeah, next up on the list, we have our health stocks. 54% allocation of this portfolio is in our health stocks, HIMS, UNH, and Oscar. The reason I have this is because one, HIMS is an undervalued growth beast. Oscar is an undervalued growth beast, and United Health Group is just at a very depressed stock price based on how big of a moat they have, how big of a Goliath they are in the health insurance industry. They are number one in the health insurance industry. They're such a Goliath. They've had bad news after bad news after bad news, and the stock has gone from a little bit overvalued and now is completely swung in the opposite direction down to completely undervalued. Basically what I'm going to show you here. And before I get into that, the biggest reason I sold out of Tempest and PayPal, there's nothing wrong with those stocks. I still hold them in my other portfolios. The biggest reason I sold out of them, honestly, guys, is just because I believe that D'Lo, Hims, UNH, Oscar just have such better upside and growth in front of them. And I just believe that, Tempest has a lot of growth in front of them as well, but they're not yet profitable and they're not yet there, like Hims and Oscar and D'Lo are right now, that are severely undervalued and fundamentally undervalued and bring in free cash flow and net income positive numbers. Tempest just isn't there yet, so it's a bit more of a speculative stock, I would say. And PayPal just, I think it's finally going to start getting moving here, but they do have a lot of competition, and I do like them again. I think they're undervalued, but I just I need to put more money into Oscar here, 24% weighting, with such a undervaluation on this name that I couldn't pass up the opportunity to build this out into a bit of a bigger position across all my portfolios, especially this $10,000 portfolio here. So, yeah, when you want to build out positions bigger, you got to make cuts in other places. And so basically I cut out PayPal and moved in D'Lo because I think it's a lot more undervalued and much more upside. And then Tempest just doesn't stand with Hims, Oscar, and United Health Group. That's just the very simple brass tacks of it, honestly, guys. So those are my reasons for selling completely out of those in this portfolio. Nothing against those stocks. Still love them for the long term. But like I said, you got to make moves sometimes. And yeah, they just didn't make the cut. Sorry. So let's rapid fire through these because I've already talked about these at length. Hims and hers, just completely going after I mean they got Nvidia level growth, guys. 111% revenue growth, 321% cash flow, surging subscriber monetization. They're really going after the younger generations, just like Hood, just like SoFi did and continue to do. They're winning with their packaging, they're winning with their customer service, they're winning with their complete and utter UI of their applications, and just making medicine, making mental health issues, making all of it seamless and simple for everybody. They're making it seamless and simple for everybody, and they're making it normal. They're making like just deliver it right to your door. You don't got to worry. It's okay. Good packaging makes you feel good about getting help and treatment. And everybody thinks the GLP ones with this company, with the Envy, with the Nova Nordisk deal going out the window. It's just created another dip buying opportunity when this name was just pushing 70s and I thought they were going to go to 100. And then the Nova Nordis news hit, and then this stock cratered obviously like 30% in one day. That's what you get with HIMS. You get a very volatile stock because it's still only a sub $11 billion market cap. But make no mistake, the blueprint you see with SoFi, the blueprint you see with um, Robinhood is what HIMS is doing in that pharmaceutical healthcare network, right? So, yeah, if we go over their SWOT analysis, explosive revenue growth strengths, I would also say UI and just overall customer service. Subscription model reliance is their weakness. That could be a really weakness for any subscription product. Opportunities, new treatment categories. They just launched their little Apple gummies, which are basically like you get all your vitamins in one little gummy. Super awesome. They're starting to combine pills. They're starting to combine like hair growth and ED, a pill in one. So like a wonder pill. They're just so innovative in what they're doing, and they're making things so simple and simplistic. You just gotta love what they're doing over here and what Dudham's doing with this company. Telehealth competition, yeah, plenty of competition, but again, um, having more subscribers, having more people using their app consistently is going to be able for them to feed them other products like the telehealth product and making it an all-in-one healthcare app. I would love for Hims and Oscar to just team up. I think it'd be a super team, health insurance and healthcare all in one app. I think it'd be absolutely phenomenal. But yeah, Hims is supposed to grow in the 20 to 30% range for the next 10 years, as far as the eye can see. They have so much room to expand there, just killing it on all aspects. We have an $86 fair value on this name, currently 44% margin of safety after the fall. And after the small little bit of a rebound, they're about $49 as of Friday. And yeah, 30% CAGR on this name based on a DCF and about 12% or so on an EPS CAGR rate. Their EPS is growing slower than their free cash flow, but with a growth beast like this, you see the same thing with like a Palantir. Their EPS is going to come along slower, and their free cash flow is really going to be exploding, which is what we see with this company. So yeah, absolutely love this company. Still think it's a buy. Peg ratio is 0.44. Yeah, of course, if you look at a PE forward PE or free cash flow yield, it looks a little bit expensive here. But if you just realize how big of a company this is going to be in the future, how fast they're growing on the revenue side, their free cash flow, how much that's growing, and their free cash flow margin rate and their overall margins overall, and just how much they're killing it on all those aspects, guys. So next up, Oscar, super undervalued. I've talked about Oscar so much here and on X. It is completely undervalued, guys. It is a steal deal today after the big drop, after the BBB bill passed, or the big beautiful bill, and how that passed, and then also I think it was CT. I can't remember the ticker symbol, but another health insurance company. They basically came out and they slashed their guidance, and then that caused UNH, that caused Oscar, that caused a lot of the other Atnas and other players in the health insurance industry to absolutely plummet. Oscar the most because they're the small guy. They're less than $5 billion market cap. But guys, like 5 to 10% free cash flow margin rate, they're currently doing like 10 to 15% free cash flow margin rate. Their free cash flow yield's insane. Their forward PE is a 24 for like, I believe they can grow 20 to 30% just like Hims. And I've really beaten up the numbers over here on the revenue growth rate. And they're still a buy all day. I could put all these numbers as a zero and they would still be a buy over here. So if they did zero revenue growth for the next 10 years, they're still a $32 fair value stock. And really the biggest thing here, guys, is that people don't understand that ACA subsidies are getting reduced and some of them are getting taken away, right? Not actually ACA just completely going away. So yes, Oscar relies mainly for their revenue, like 92% of it on ACA revenue, but it's not all ACA going away. It's some of the subsidies going away, not all of ACA just going away. Some of the subsidies are going away. And so That's where ICRA comes in. And that's where ICRA comes in to basically alleviate that issue, and to basically build into that area of um, of health insurance, right? Going after Uber drivers, going after Uber Eats drivers or Door Dashers, or going after um, people like me that have their own business that do all of this, trading and everything to provide for their families. So yeah, I really like Oscar. Oscar is my number one stock right now, hands down, no, bar none. It's the number one stock that I love most right now. And I believe that they are going to be a minimum five bagger, if not 10 or more X on what I have invested in this name. Their leadership, their CEO, their the team that they have, the connections that they have with the Kushner family, bar none, this company is people just still don't see it. And people were upset when the stock went to 20s, and people were upset they couldn't be buying at sub 20 or 15s or 16s, and you got another chance right now to do that. Whether or not you take advantage of this opportunity, um, is on you, right? But I'll tell you, the lower it goes, the more I'm buying. The lower it goes, the more I'm buying. I'm not looking to trade this. I'm not looking to make money on this in a month. I'm not looking to make money on this December 2025. I'm looking to dollar cost average into this company for the long run for the next 3, 5, 10 years and reap the rewards just like everybody else reap the rewards of Palantir, Robinhood, Nvidia, AMD, so on and so forth, guys. That's my plan. That's my plan as a long-term investor with Oscar, right? You want to trade it, go ahead. But don't be surprised when it's 3, 5 years from now and you said, man, I had that many shares and they're worth what now? Okay. We're all going to play our own books, but I'm just telling you, $59 fair value on this company based on a discounted cash flow model. Currently for 2025, a $20.46 fair value, which is almost a 20% margin of safety from where they are now. 2026, it's another 20% margin of safety at $29.67. So EPS, check. It's a buy. Discounted cash flow model, check. It's a buy. Free cash flow yield, it's a buy. PEG ratio 0.28, well under 1. So that's a buy. PE ratio forward, it's a buy. Not current, 164. But like I said, they're about to explode from 10 cents to 68 cents from 2024 to 2025 on that EPS. Somebody hit me up in the due diligence or in the investing tier. If you guys want to be part of our Discord community, like I told you earlier, there's a 50%. This is $29.99 right now for the high five investing tier. $29.99. You get it for 50% off until Monday. So tomorrow's the cutoff. Go to my X at the RonnieV show. Click the link. You can come on here or just click it in my bio in the description below, and you can get 50% off by using code America. Okay, America. So we got buy alerts, sell alerts. We got the high five gems, the gems portfolio, the community portfolio, the leaps portfolio. We got DD. We got investor chat. We got stock levels. I give you all the levels for all the different stocks out there when you should be buying. We got covered calls, cash secured puts. We got it all, guys. We got it all for $15. You get it for $15 this month. Steal deal. Yeah. I don't know. I don't know how else to. I mean, I've beaten the horse dead with Oscar, guys. Can't say anything more about it. UNH, they're a bigger company, $280 billion market cap. They're a very large company. And the biggest thing you got to know about this one is just completely undervalued. They have a moat. Oscar's not going to come and completely knock them off the pedestal. Oscar's going to coexist with them while taking, 1, maybe 2%. And that 1 to 2% is going to make Oscar very fat and happy. And it's going to explode their revenue. It's going to explode their free cash flow. And it's going to make me really fat and happy with all the money I'm going to make from Oscar, just taking on 1, 2, 3% of the total, multi-trillion TAM, total addressable market in the health insurance sector. So yeah, guys, UNH though, being conservative with the free cash flow margin rates, being conservative with the revenue growth rates, just looking at everything, 400 billion in revenue and 25 billion in free cash flow. Massive free cash flow, right? It's a buy on free cash flow yields, forward and current, 8%. It's a buy on their PE, 11 and 14 forward. 0.66 a peg ratio for not a growth company is pretty awesome. Not being a growth company, meaning like they're only supposed to be growing, in the teens, or sorry, in the single digits mostly over the next 10 years. But yeah, 15 terminal, you get a $546 fair value. Yes, they have lawsuits coming up. Yes, they have some hiccups along the way. And yes, they're in negative light right now overall, but this is the best time to be buying when companies are in a negative light, because eventually that light does shift back into either no one cares about them anymore and then they just go on quietly doing their business, or they switch back into they're probably never going to switch back into a positive light, because this is health insurance and you're dealing with people's lives and their illnesses and everything. So yeah, you're probably not getting that, guys, but I mean, you don't need that. You just need United Health to basically go back into the shadows and just be normal again, and no one's talking about them anymore because they've just been talked about so much since their CEO passed away and was executed. Yeah, all that stuff. So not great. Yeah, even on EPS, $388.49 is the fair value in 2026. And yeah, it's a buy all day here. Did you get the bottom? Did I get the bottom? No, I didn't get it in the 200 and some, but I don't care because it's 44% margin of safety. That means it's 44% under its intrinsic value. It's 21% under its EPS fair value. So I don't really care that I didn't get the bottom, right? It happens. You're not always going to get the bottom. I just know that UNH is going back to a $4, $5, $6, $700 company share price in the next 1 to 3, 5 years. 1, 3, 5 years. Okay. That's all I know, because they are the moat. They are the dominator in the health insurance sector, and they're currently $308. And I know I'm like, this is an easy double. This is an easy double to me. Easy double up of my money for me. So that's why I'm choosing to be a buyer of UNH here as well. And that is also why I have 54% allocation to health stocks right now, because Meta, Amazon, and Google, do they still have more room to run? Yes, they do, but their margins of safeties are 20% or less. Finance world, I put it in D local. A lot of other of the finance companies, again, are about 30% margin of safety or less. So not as much opportunity. I think the biggest opportunities out there right now in this market are in the small and mid caps. And part of that, and some individual like value plays, and that value plays UNH with a massive margin of safety, and then just Hims and Oscar just attacking this healthcare sector, disrupting two legacy dinosaur sectors: the pharmaceutical sector, healthcare sector, and the health insurance sector. Coming after those dinosaur legacy sectors and massively disrupting. They got a lot of people talking. I think they're going to continue to do well in these sectors, and I think I'm going to do very well with having in this public portfolio such a large weighting in these health stocks over the next 1, 3, 5 years. If you guys enjoyed this video, smash that like button, hit the subscribe button for more videos like this. This is a beast of a video. My voice is starting to go, but I hope you guys enjoyed it. I love you all. Hope you had a great 4th of July. Hope you had a great weekend. And let's get ready for those markets to open tomorrow morning. And let's get back to making money and long-term investing. Love you all. Have a great and amazing night. Talk to you in the next one.